Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics on Wednesday, July 6th. Hope everybody is doing well out there. And we're about to get started with today's roundtable, going over how the money supply is finally set to begin contracting. We've heard the Fed raising interest rates for last couple months, another interest rate hike on course for July. So we'll dig into all that, what it will actually mean. And I'm quite fortunate today to be joined by Rafi Farber of the Endgame Investor, who gives us his great silver report every Friday. So Rafi, welcome on in. How are you?
I'm great, Chris. How are you?
I'm doing well. Appreciate you all being here. We also have Dave Kranzler down there. It looks like he's checking a chart, getting ready. Dave, Investment Research Dynamics. Appreciate you joining me as always. And how's everything going with you today?
Good to see everyone.
Well, it's a pleasure to have you on here, and also joined by Rob Kientz of Gold Silver Pros, who also tracks all these developments. So Rob, I know some are upset, no cowboy hat today like Bill Holter, but good to see you. And how's everything going with you today?
Going well, Chris. Thanks for having me on. Hey, Dave. Hey, Rafi. How are you guys?
Hey,
Rob.
good to see you again.
Well, I appreciate you all being here, and let's hop right in. I'm going to pull up the chart of the M2 data, which shows a pretty one-way trend over the last 60 years that we have the chart. And you can see certainly things spiked quite a bit in 2020. There you go at 15,458 before COVID. And now we are at 21,754. Although, Rafi, you were the one who was pointing out last week that you're looking at the data, and it seems we're a couple of weeks away from actual contraction. So why don't you take it from there and let people know what you're seeing and what they might want to be prepared for?
Okay, so this chart that you're showing here is a little bit less precise than the one I'm looking at because this is monthly and I'm looking at weekly. So what I'm looking at is a bit more nuanced than just the straight money supply. I'm looking at the 13-week average money supply. So it's calculated every week, and then you take the last 13 weeks, you average it out, and that gives you the most basic of trends. So you take this 13-week money supply average, and then you subtract it from the previous 13 weeks before, and then you get a quarterly rate for how much money is being created in the quarter, and then multiply that by 4, and you get an annual rate. So this is really the first time since September 2008 where that number is set to go below zero, meaning we're going to have absolute contraction, deflation in the Austrian school sense, meaning deflation of the money supply, not necessarily prices of things, but of the money supply itself. The last time that happened was September 2008. It almost happened in July, August 2015. And if you remember that day, that was some crazy, flash crash sell-off where the NASDAQ, I think, went down like 1,100 points, and it was much lower than it was now. It happened in 1987, October 1987, and it happened in July 1929, 3 months before the big stock market crash. So exactly what happens, exactly when a crash would happen, I can't say. It's going to be probably within a few months, but I can't give an exact date. And what happens to gold and silver when that happens? The last few times it happened, there was a sell-off in metals also, but followed by the Fed's final pivot. And then, metals went crazy after that. So this time, if the Fed does another pivot, which it will have to, this could be the one that kills the dollar. And I see it happening sometime before November, if the numbers are correct.
Yeah, and Rafi, you mentioned gold and silver there, and I will pull up a quick feed here because interesting, we had silver was tailing off a little bit, although now up 7 cents, while gold is still down $28. And Dave, I know you had some comments as we were talking on the phone earlier this morning about what's going on there, and of course also to what Rafi just said. So why don't I let you take it away?
Sure. I mean, if you look at a 24-hour chart of the gold price, you can see there's certain periods where all of a sudden there's like flash crashes in the price. And normally, typically, if you go to the technical chart, it's a better graph, and go 15-minute chart. Normally, more often than not, I'd say probably 80 to 90% of the time, those flash crashes occur during the period of time during the day when it's London and New York that are open, not the Eastern Hemisphere physical gold buying markets. So, and yesterday was a good example. So there was essentially a flash crash at 10 a.m. New York time, and that correlates with the PM London fix. And as it turned out, there was a massive amount of selling at the fix. Now, this isn't necessarily, it's not like the banks are taking gold bars out of their vault and selling them on the LBMA, and then the buyers are taking them and either putting them in their own vault or putting them back in another LBMA bank vault. This is basically commitments to buy and sell gold based on forward contract positions. So and that's why it's called a fractional bullion system, because when the fixed price gets settled, it's not like the bars get moved around from vault to vault to allocated account and allocated account. It's basically bars sitting in an unallocated LBMA bullion bank vault that they represent as being available to be delivered should the buyer want to remove the bars from that vault, that particular vault. So it's almost the same setup as the COMEX. It's a paper derivative market, but at any rate, there was a massive amount of dumping yesterday. It pushed the price down $11 during the course of the fix, and it's extremely rare when you get a double-digit drop in the gold price on either the AM or the PM fix. And the same identical thing happened today. If you go to a chart, you'll see that starting at, and I tied it to, I pulled up a 1 minute chart, and almost exactly at 10 o'clock, the flash crash begins, and the price of gold was pushed down from 1758 to as low as 1731, and it's rebounded a little bit here. So again, I mean, my big bone to pick with people who are commentating on this market or freaking out over it is the price that we're observing is the price that's being set using the paper derivatives market. It's not like there's large buyers or large sellers of physical gold out there. I mean, yeah, mining companies are selling physical gold, but that's their business. And coin dealers are selling physical gold, but that's retail oriented. That doesn't really, even at the margin, it doesn't necessarily affect the market. So, what this is it's predatory selling to manage the price of gold lower. And there's a reason behind this. And, it ties into the work Rafi's been doing on the money supply. And that is, we've got a major problem brewing in the global financial system. And there's evidence of this. If you look at like the MOVE index, it's basically the bond, the VIX for the bond market. And it's now at its highest level since 2009. And then there's a couple charts going around that show the cost of credit default swaps. And the cost of credit default swaps are back to where they were in March 2020. Well, we know what was going on in March 2020. Yeah, and see on that chart, it's as high as it was in 2009, but it was coming down it was coming down at that point. Look at where it is versus when it started going up. It was right, it was actually started happening before Bear Stearns imploded. And then right before, we had, which I call it a de facto financial system collapse. Other people refer to it as a great financial crisis, which, kind of is August, September, October 2008. That's, we're back to where it was then, and we're moving higher. So this reflects that there's a big problem brewing in the global credit markets, and the cost of credit default swaps reflects the same thing. So something's going on, and this period of time that we're going through with the precious metal sector reminds me exactly of the summer of 2008 and what happened back then. The system blew up. We bottomed in late October, early November 2008, and then went on a massive 3-year bull run.
Well,
Wash, rinse, repeat.
Makes a lot of sense. There are a lot of similarities. Perhaps one difference is that the Fed was already cutting in 2008 versus now. I think this is the first time we've seen them hiking rates into a recession. And Rob, I know you've been following this as well. What are you thinking about everything that we're seeing happen now?
Yeah, I like all the points that Rafi and Dave have made, and it's all really good data. And I think if we just were to look at this as another market crash, that's where you would stop. I think the last couple of weeks on my live streams, I've been going further. Last week, I talked about the derivative mess because that points to the amount and the size of what this collapse is going to be. And then last night, I pointed out that basically, I think the big money front ran the Fed and all the central banks. And what I put together last night was the money stock has moved. It's gone, the M1 and M2 have gone lower since March, according to the Fed's charts. If you look at the data tables, however, there's still enough sloshing around in the economy and reserves. It's not as if we've hit the big crash. So I think what Rafi is predicting is going to come true. He's absolutely correct. Preceding all the previous big crashes, you had specifically a retraction in M2. But what I also found was the selling, the outflows in the bond and stock market started back in September and December. And then I found a Reuters article, and of course we all knew that this was the case, but it's interesting to see in the financial media that the central banks were talking July of last year about tightening. And I think there was a lot of signals to big money, hey, this is coming next year. And so you put that together and you see all the people moving money out of bonds and stocks dating back to last September. And to me, that just says the big guys were front running what they knew was going to happen. They knew that the Fed was going to tighten. They knew that the money supply that had been created M1 and M2 and M0 that had been created during the pandemic in 2020 was eventually going to hit inflation. Then what happens? Now we have inflation. Right. But the big money, I think, got out of a lot of their positions in stocks and bonds before the inflation came. And it may seem counterintuitive for a second until you look at something called real M2. So expanding upon what Rafi has been documenting so well, the real M2 is a Fed chart that's put out where you look at M2 deflated for the CPI. Now, I don't think any of us on this program thinks the CPI is the real inflation number, but let's just use it. It's the government printed number. If you look at the real M2 deflated by CPI, it's been falling for longer and more precipitously, which basically means in a nutshell, the money now that's sloshing around the economy has less effectiveness. And it also means that the end game for the Fed is here. The Fed cannot print more dollars and have it stimulate the economy because of inflation. As long as there's high inflation, the more that they print, the marginal value of each additional dollar actually becomes negative. And that's at the point where we're at. So this is the end game for the Fed. But I think if you add that to the fact that people were getting out of assets and were front running what they knew was coming this year, I think it's pretty clear that what's happening is the big financial players are trying to, the people are going to be left holding the bag. They're going to give the bag to the people. They've already started exiting their positions and getting out of Dodge. So I think it's more of a planned demolition, in my opinion. And I would argue that 29 and 2007, 2008 were similar. But this time is different. And this is what I want to impress upon the audience. This is the end of a fiat system. This is the end of the dollar. It's done. It's toast. We're going to have the central bank digital currencies if the people will accept them. Who knows? Maybe Bitcoin does well. Gold and silver will certainly do well. But this is the end of the dollar. So it's different than 2008 and 29. We're out of that system. This is a collapse of the 100-year monetary system. This is also, if you consider the research of Sir John Glubb, the end of the dominance of the United States as world superpower, because that happens about every 250 years when you look at his research, pretty much like clockwork dating back to the ancient Assyrians. So we're going through bigger changes. So the bigger thing is, how much did the financial elite get out of the system before they started to crash it? Because remember, the Fed is a private entity. It's owned by big shareholders, which are commercial banks and wealthy families. And they know what's going to happen before it happens because they're the owners of the Fed, even though the Fed, quote unquote, reports to the US government. It's a private banking entity. And so it's a controlled demolition. My question is, how big is it going to be? I've always said, dating back to when I wrote the book 13 years ago, it's going to be bigger than the Great Depression my parents lived through. It's going to be bigger than what we saw in 2008. And I think we're seeing the death of the financial system. I think we're seeing a reset. And I think the new era that's ushered in, if you're not in gold and silver specifically, you're going to be in trouble, because I don't think anything else is going to have value. And what I've been talking about the last few weeks is extras pyramids folding in on itself. All the value is coming down from all those derivative crap that the big money's gotten out of, and it's going into gold and silver. And so I think this time is going to be different. I'll be talking about that at Silver Symposium here in August. That will be my presentation. This time will be different, because it's the demolition of the current system and ushering into the new system. So I think it is everything that they've said, but I think it's also more than that. And I want to broaden that picture for people to look at, the players, what's going on. where those money flows are going. And you watch the money flow into and out of assets, it's pretty clear what happened and who benefited from that and who's not going to benefit from that.
Well, that makes sense. And in terms of a few money flows, I'd like to pull up here. Here's the Federal Reserve's balance sheet. You can see again, 2008 back there at 893 billion, now up at just about 9 trillion. So a 10xer there. And if you look a little closer, here's the 3-month. It's not really getting any smaller yet. I mean, it has gotten smaller, but a peak back up. It's not like that's coming down all that much. And then also here we have securities held outright, mortgage-backed securities with a similar pattern. We see a lot of growth and then not so much. I mean, it's been flat, maybe about set to come down. So for all the talk of withdrawing credit, raising interest rates, we really haven't seen any reduction yet. And Rafi, perhaps you have a comment on that one?
Well, we haven't seen much reduction, but we don't need to see reduction, because in order to sustain a boom, you have to have a consistently increasing money supply or a consistently increasing liquidity supply, however you want to define it. And as soon as they stop, and then that eventually puts money supply growth in reverse, and that's going to hammer asset prices, but it's going to keep consumer prices elevated because, you're not going to like suddenly, even in 2008, right, when at the worst of the deflationary crisis, it's not like the prices in supermarkets were really noticeably falling. At gas stations, yeah, but like it's not like you could buy food for cheaper in 2009 than you could in 2008. It pretty much stayed stable. So we're going to see the same consumer price inflation, even worse, and we're going to see falling asset prices. And that's just going to freak people out and cause them to chase consumer goods even faster because they can't hold their money in assets and expect it to grow anymore.
Well, that makes a lot of sense. And Dave, what do you think about that?
I mean, I agree with Rafi in terms of the implications of the Fed balance sheet not growing. I mean, I've said all along, if the Fed doesn't keep printing money at an increasing rate, then if it just even if it just stops printing, and doesn't reduce its balance sheet, it's going to cause a collapse in financial assets. And I guess what Rob was suggesting, and I can't disagree with this, is, in economics, there's a law of diminishing returns. And it means, at a certain point, more of something has no value. And so to Rob's point, it's probably we're at the point where printing a lot more money has no value. And that may be why, if indeed there is a great reset that's in process right now, that may be why they've decided to do it now.
Yeah, and Dave, as I've been thinking about the comments from Jerome Powell, the other Fed officials, certainly it seems like he's willing to keep raising interest rates right now, and he's going to continue at least pledging to do so until there's some impact in inflation. Now, whether you're looking at the core PCE deflator or the CPI, I think it was surprising last month when the CPI came in a little higher, which made it a little more difficult to back off. Yet you could have a couple more interest rate hikes and see that number come down a little bit. If it goes around from 8% to 6% or 5%, we're not talking about prices going down, but to the degree that the way the Fed looks at it, the spiraling out of control inflation has stopped. I wonder if we'll see a couple more hikes this year and then see some of these data indicators come down, not back down to 2%, but then that will be the part where the Fed can pause and see how long that goes. Again, we also have rumors of food shortages and a whole bunch of other things, war in Russia going on at the same time, which makes me wonder, is it going to say, the Fed going to say, we're going to raise interest rates, although be accommodative, and then something happens and they cut again. But is that a reasonable path or timeline of what you could see happening over the next couple months?
I mean, for me, it's pointless to base conversations on PCE or CPI because they're bullshit and they're bullshit numbers, right? I mean, the core PCE doesn't include food and energy. Well, what do people spend 70% of their disposable income on, or whatever the number is? You know, food, energy, and shelter. So, I mean, essentially, the CPI and the PCE are whatever the Fed and the Bureau of Labor Statistics want them to say. But let's just say, okay, let's just use the CPI. Well, where the Fed funds rate is where? Is it 1.5 to 1.75 or 1.75 to 2? I forget.
1.5 to
Because it's
1.75.
Yeah. Okay. So, and the CPI year-over-year inflation rate is what, 8.6%. So you know the rule of thumb historically is that your interest rate, your Fed funds rate, should be at least equal to the rate of inflation. Well, we're not even remotely close to that. So you still have just using the BS CPI number, you still have highly negative interest rates, and to some extent, that's almost the same thing as printing more money. So they're a long way away from arresting real inflation, and they can use their propaganda statistics and try to convince us of that. But on Main Street, people don't believe it. And it becomes obvious that they're lying. And that's part of this process that Rafi and Rob are talking about, where people just lose complete confidence in the Fed, the government, and the currency. And, then it's lights out.
Well, I think what you're saying makes a lot of sense. I agree with your assessment of CPI or the PCE deflator. Although, Rob, again, just to the degree that the Fed cites these, what do you see happening in terms of the next 6 months, or this path of going from hiking now to where we might end up?
The Fed's between a rock and a hard place. And I think those of us, I know you're in this category, Chris, everybody on this call is in this category. We all knew that the Fed would reach an end game at some point, because that's been the history of fiat currencies. Rafi does a great job of talking about that all the time. He did on Seeking Alpha, he does on your channel and on his channel. We know the system has to end eventually, but you have to remember it wasn't built in a day, and it didn't fall in a day. It does take time for this stuff to occur. I do think, and I've used this example, I think what they're trying to do is get certain people off of the Titanic before it sinks. I don't think they care about you and me, to be honest. I'm going to be brutally honest. I don't think they give a shit about us. But I think that they're trying to get certain people off the Titanic into the lifeboats. And so they're going to manage as it goes down. And that's Powell's job, is to manage this situation. Powell knows the end game's here. He's not stupid. He came into the Fed wanting to tighten right away. He can't do it because of the position he's in. He's a generation too late. We've had, he can't be Volcker. We've had too much debt printed. You can't service the debt at 18% interest rates. He's not going to be able to hike anywhere near there. And look at what happened when they did a 1/4 point hike and then a 1/2 point hike, and then everything went to hell in a handbasket right off the bat. And it's going back to what I said: the marginal utility of each dollar printed is not only not as much as it was before, it's becoming negative because it's stoking inflation. So let's go back to definition of inflation, which Dave used on my show last time he was on. Inflation is an increase in money supply. It's not an increase in prices. Now, the media will talk about an increase of the prices, but what's happened, the money supply has already been blown up. It was blown up until 2020, and then 2020, it went near vertical. And so you have all that sloshing around. But as I pointed out on my show last night, most of it went to M1, which are more for the commercial entities. Less of it went to M2, which is more like savings accounts, money market accounts. So it wasn't going to we the people. It was going to the commercial end. And they were able to use that last bit of amount of money to eke out, whatever they needed to do. But now that the margin utility of dollars is falling, the Fed's not going to be able to come back, and print that away. And they want to tighten because their theory tells them to tighten in this cycle. Modern monetary theory, Keynesian economics, you can manage aggregate flows in the economy by managing what? Supply of currency. They think that this goes on forever. It never has in history, but they believe that. So they think they tighten a little bit now, and then they ease later, it's going to be okay. But it's not, because we're at the point of no return. And we know this. We know Kenneth Rogoff's research on debt to GDP ratio. All the statistics tell us you're past the point of no return. We know it, and unless you can use alchemy, and turn fiat dollars into gold, you're not going to be able to solve that problem. So I do think that they're going to continue to tighten. They have a goal of 3.8% this year. That changed, by the way, from 1.8 or 1.9 in December. So they think they're going to get up to 4%. I don't think they're going to be able to. For every 0.5% that they get it up on new treasury issuance, it creates almost $1 trillion it creates about $1 trillion in additional spend that the government has to have to service that debt. And if you look at the existing bond market complex, when you raise interest rates and bond rates go up, the value of the currently held bonds goes down. That's going to exacerbate losses across the sector. We're talking corporate losses, we're talking sovereign losses. So they can't just do whatever they want. There are consequences to everything the Fed does. And so, yeah, they're going to hike some. And I think they're going to provide some cover for the cronies that essentially own the Fed. Again, private institution. It's not federal, has no reserves. Okay. Private institution until they can't anymore. I think we're in the middle of a deflationary crash. I think that's what Rafi had pointed out with one of his recent videos with M2 and the deflationary crash that's coming. And so I think they'll bring out the helicopters, but it's over. Okay. It's just, we're at that point. It's over. Now, how long that takes, like I said, you know, the destruction of economies don't happen overnight, but we're definitely in that 11th hour. We're at the last stage of it. We're at the point at which whatever they did before is not going to work. And so for people watching this video, you do have a little bit of time. I wouldn't say that you have years, but you have some time to position yourselves and to get ready. If that's precious metals, whatever you want to do, whatever you decide to do, you want to do that now. I don't think you want to wait, because the Fed, you know, there's nothing they can do now. They're trying to control the sinking of the Titanic. The Titanic's going down. The only question is, do you get your lifeboat or do you jump in the water, in the freezing cold water? You know, that's your choice. Now, do you get on now into the lifeboat, or you take your chances with the water when it's obvious the Titanic's going down? That's up to you to make your choice.
Well, I appreciate that, Rob. And speaking of timing, we're coming up on about a half hour, so close to wrapping up here. And Rafi, I know it's getting late in Israel, so appreciate you being here. And any final thoughts before we close up for today?
From me, well, we're talking about, Rob's talking about a reset, and I agree that they're trying. And we use that term reset. And I was listening to Ron Paul today, his Liberty report, and he was saying reset is too mild of a term. You know, you take a clock, you reset it, it goes back to 12, and there's no violence or anything. But like this is more of a revolution. We are at the fault line of history right now. So this is going to be more than a reset. But the question is, on whose terms will it be? And you know, I think we give the emperors too much credit. They're still naked, and they still really don't know what they're doing. And they can't engineer a soft landing, not for themselves, not for anyone else. It's not going to be on their terms. The public is much bigger than any one of them, or even any big group of them. It's going to be on our terms. When we kill the currency, when we kill the money substitute, basically, and go back to real money, it'll be on our terms. And then what's the most important thing is the people in the public that understand what has been going on for years. It is most important that they who understand morality, who understand monetary economics, who understand justice, that they have the resources necessary to orchestrate a real reset, a real just reset, where things can be set on better footing.
Well, that makes sense. I'm ready. And before we let you go, Rafi, would just point out you can find Rafi Seeking Alpha, the Endgame Investor, where he has his column that comes out every day. One of my favorite daily reads. And then also Friday, Rafi does his weekly silver report on the show. So Rafi, thanks for joining us today. I sure appreciate that. And Dave Kranzler of Investment Research Dynamics, any final words from you, my friend?
I don't have a lot to add to what Rob and Rafi had to say. I would just say I think they're being optimistic on how this thing's going to end up as it unfolds. And I think it's going to be really brutal for everyone. And I think if you want to make it to the other side of what's coming, so let me just put it in context in it. I think we're looking at 2008 times at least 5 or 10 times in terms of severity. So if you want to make it through and see what the other side looks like, I mean, I think the only way you can do it is get rid of your debt and accumulate as much physical gold and silver as you can. Get out of the stock market, get out of the bond market, take your money out of the bank, because there's going to come a time where you're not going to be able to get it out of the bank. And I mean, I'm not saying go out and become a hardcore prepper, but these are kind of simple things that you can do to protect yourself and your family going forward.
Well,
And also just enjoy what you can while you can, as much as you can, because who knows how much longer this is going to last.
Yeah, and Dave, I appreciate what you're saying. It's not the easiest time for anyone because there is no exact set solution. Although I don't think you're fear mongering. When we look at what's happening, there is something.
I'm not fear mongering. It is
here,
what it is.
You can find Dave at Investment Research Dynamics, where he has his blog and also publishes the Mining Stock Journal and the Short Sellers Journal. So thank you, Dave, for joining us today. And Rob, any final thoughts there before we wrap up today?
Yeah, I would say, listen to Dave. He's right. It's going to be worse than last time. And I just say that from a perspective of, I understand the Great Depression, not only from studying it, but for growing up in a family in which my parents were in it. My father fought in World War II on D-Day. My mother grew up in a farm in Great Depression. So my family understands and remembers the lessons from that time. It happens about every 80 years. We're at that 80-year cycle. But I do think with this being the end of the current system, it's going to be quite a bit different. It's going to be quite a bit worse. So I would say become a hardcore prepper. If you think that that's what's going to help you get through it, buy gold and silver, listen to Arcadia, read Investment Research Dynamics reports, do all the things that you have to do. Don't just sit still on your hands, prepare. And if all you're doing is buying some gold and silver, maybe you're getting into some Bitcoin, whatever it is, that's fine. Do what you think is best. But be careful in underestimating this one, because if you study history, time is not kind to people who ignore history and don't pay attention to things that are going on around them. And if you want to pay attention, just listen to Chris's channel. He does a great job of documenting all this as we go through. And I think you can do a lot worse than listening to the guys on this show.
Well, appreciate that, Rob. And people can find you at Gold Silver Pros. And Rob, you're going to be up at the Silver Symposium next month, did you say?
Yeah, I will be.
All right. Well, you can meet Rob in person at the Silver Symposium. So I thank you for joining us. And also would like to issue a thank you to Kuya Silver, who brought us today's episode. Did have a note here, Kuya Silver showing up on the top of the insider buying list. And here was David Stein, president and CEO of Kuya, who I have on the show about once a month, now holds over 9 million shares, 20% of the company. So obviously a challenging environment. We've seen a lot of the silver stocks sell off, especially on the junior side. Although nice to see that David is investing in his own company. They did have a preliminary economic assessment out, which was filed back in June. And for everyone watching on the replay to find out a little bit more about what Kuya has been doing, especially in this environment, well, there'll be a video coming up your way in a moment. And for everyone watching live, just want to thank you for being here. I hope this was helpful and fun part of your day as we figure out what's coming next. But thank you to everyone, as well as my panelists, and we will see you again soon. And we are clear.